All right, let's dive into S&T Bank's second quarter earnings. Now, this was a really interesting one because on paper, they knocked it out of the park. But the market, well, the market had other ideas. We're going to figure out what the headlines missed and why the stock went down.
So you've got this paradox, right? The company reports better than expected profits, better than expected revenue, and investors immediately start selling. So what gives? What did they see that made them so nervous? That's the puzzle we're going to solve today.
Okay, let's put some numbers to this because it really is a head-scratcher. S&T beat earnings by 2 cents a share. They beat on revenue by almost $1 million, and yet the stock drops nearly 2%. It's no wonder analysts were kind of left shrugging their shoulders, calling it mixed. This is the core of what we're digging into.
So, to really get why the market got spooked, we first have to talk about what went right. You have to understand that the bank's core engine was absolutely firing on all cylinders. And that story, well, it all starts with one of the most important metrics for any bank.
For anyone who doesn't live and read this stuff, net interest margin, or NIM as you'll hear it called, is pretty simple. Think of it as the bank's profit margin on its main job, taking in deposits and making loans. The wider that margin, the more money the bank makes. It's a huge deal.
And S&T's NIM didn't just inch up, it expanded by a really healthy 7 basis points in just 1 quarter. Now, that's impressive on its own, but how they did it, well, that's where it gets really interesting. It shows some seriously smart management.
So how'd they do it? Well, it was pretty clever, actually. They were basically swapping out old, lower-paying loans for brand new, higher-paying ones. The new loans they were writing had a yield of 6.52%. At the same time, the old loans that were getting paid off were only yielding 6.36%. That little difference is what powered that big margin expansion.
Okay, so the profit engine. It was humming along beautifully. But what about the loans themselves? Are they any good? And is the bank actually growing? Well, the good news just kept on coming, painting a picture of a super healthy core business.
You know, management themselves called their asset quality pristine. And you know what? The numbers totally back that up. Bad loans fell to a tiny, tiny fraction of their portfolio. They felt confident enough to reduce the amount of cash they set aside for future losses, and actual loan write-offs were super small. Bottom line, their loan book is rock solid.
The bank was growing too, no doubt about it. They added almost $100 million in new loans. But here's where we see the first crack in this otherwise shiny picture. All that loan growth was funded by only $28 million in new customer deposits. So you have to ask, where'd the rest of the money come from?
And the answer is, they borrowed. S&T Bank took on an extra $55 million in borrowings to make those loans happen. Now, for the market, that's a yellow flag. Why? Because funding your growth with borrowed money is way more expensive and less stable than funding it with sticky, low-cost customer deposits. And that, right there, is our first big clue.
All right, so let's pivot from the good news, because this is where we get to the headwinds that really had investors worried. There were 2 big issues that came up on the earnings call. Costs are going up, and there's a big regulatory wall that they're about to hit. This is kind of where the whole positive story starts to unravel a bit. The bank's operating expenses shot up by $3 million in 1 quarter. And it wasn't just one thing. It was a bunch of stuff all at once. You had your annual pay raises, you had higher bonus payouts, and then there was this big one. Their medical costs, which they self-fund, basically doubled.
And here's the really crucial part. The CFO, Mark Coachfire, came right out and said this isn't a one-time thing. He basically told Wall Street, get used to it. He guided for expenses to stay at this new, higher level. And for a bank, when your permanent costs go up, that hits your bottom line, period.
But wait, there's more. Rising costs were only half the problem. The bank is becoming a victim of its own success because all this growth is pushing them towards a huge issue. An issue that has a name, the $10 billion problem.
See, once a bank gets big enough, once it crosses that $10 billion asset line, it triggers something called the Durbin Amendment. This law puts a cap on the swipe fees that banks can charge a store every time you use your debit card. For a community bank like S&T, those fees are a fantastic source of revenue.
And S&T was upfront about what this would cost them. Somewhere between $6 and $7 million gone. Just poof. And with the bank already at $9.8 billion in assets and growing every quarter, this isn't some far-off problem anymore. They are right on the doorstep of this revenue cliff. Okay, so let's put all the pieces together. You have a really strong core business, but it's being overshadowed by rising costs and a big revenue hit that's just around the corner. So how do we balance all that, and what does it mean for next quarter? Here's our take on it.
Here's how we see it step by step. First, you have to acknowledge the fantastic core performance. The margins are great, the credit is clean. But step 2, you have to factor in that the growth was funded with more expensive borrowed money. And finally, you look to the future and see these two big clouds, a permanently higher cost base and that looming Durbin revenue hit. So for our next call, here's what we think. We're actually predicting a slight earnings miss next quarter as those higher costs really get locked in. That strong margin performance we saw, it's probably going to get canceled out by that new $57 to $58 million expense level. Because of that, we're giving the stock a market perform rating. It's not a sell, but with these headwinds, it's going to be tough for it to outperform the rest of the market.
And of course, just a reminder, this is not financial advice. We're providing this explainer for informational purposes only.
But we'll leave you with this one last thought, a potential wild card. Management made it very clear that buying other banks is a big part of their strategy. So could they go out and buy another bank that's big enough to make that $7 million Durbin hit just feel like a rounding error? Now that could be the move that changes this entire story.